Today, I'm going to blow your mind with the most insane battles in financial history, where ordinary futures contracts nearly destroyed entire economies, bankrupted billion-dollar companies, and created negative oil prices that defied every economics textbook ever written. Imagine this, an 8-minute trading session that shut down China's entire bond market for 18 years, oil prices dropping to negative $40 per barrel, and a nickel squeeze so extreme that the London Metal Exchange literally had to rewrite the rules of the game. These aren't just stories, they're masterclasses in how leverage, greed, and desperation can create market chaos beyond your wildest imagination. Let's dive in. Our first battle takes us to 1995 China, where an ordinary treasury bond futures contract coded 327 became the center of the most legendary financial showdown in Asian history. Here's the setup. China's Ministry of Finance had a secret policy about treasury bond subsidies, but nobody knew the exact numbers. This uncertainty created a perfect storm, two massive financial titans betting against each other on opposite sides. In the red corner, Guo Securities with their ally Liaoning Guofa convinced that bond prices would crash. They went all in with 400,000 short contracts. In the blue corner, China Economic Development Trust, betting that subsidies would keep rising and bond prices would soar. But here's where it gets insane. When the Ministry of Finance announced higher subsidies, Guo's position started bleeding money. Instead of cutting losses, they doubled down to 800,000 contracts, then tripled to 1.4 million contracts. Picture this. With 40x leverage, every 1 yuan price increase meant a 280 million yuan loss for Guo. They were staring at complete annihilation. Then came February 23rd, 1995, the day that changed everything. In the final 8 minutes before market close, Guo launched the most desperate attack in trading history. They dumped a staggering 20 million contracts into the market, crushing the price from 151.3 to 147.4 yuan. But the exchange said not so fast and voided all transactions from those crazy 8 minutes. Guo's instant billions in profits vanished, replaced by 1.4 billion in losses. The company collapsed, their CEO got 17 years in prison, and China banned treasury bond futures for 18 years. Now let me explain how futures can get absolutely wild with my concert ticket analogy that'll blow your mind. Imagine Taylor Swift announces a surprise concert at Madison Square Garden, 20,000 seats available. But here's the twist. The futures exchange creates contracts for these tickets with no limit on how many can be traded. If 100,000 fans want to buy tickets and 100,000 scalpers want to sell them short, betting prices will drop. Boom, 100,000 contracts appear instantly. But remember, there are only 20,000 actual seats in the venue. Now, here's where it gets insane. What if a mega fan buys 50,000 long contracts and refuses to sell because they want to give tickets to all their friends? The short sellers are absolutely screwed. They either pay massive penalties for not delivering tickets they don't have, or they panic buy from other holders at any price to close their positions. Suddenly, ticket prices rocket from $200 to $2,000, then $5,000, because there simply aren't enough real tickets to go around. That's a short squeeze in action, when paper promises collide with physical reality and the laws of supply and demand go absolutely nuclear. And trust me, it's about to get very real in our next stories. Fast forward to 2022, Russia invades Ukraine, nickel supplies get crushed by sanctions, and the world's biggest stainless steel producer, Tsingshan Holdings, finds itself holding a 150,000-ton short position they can't deliver on. Here's the perfect storm brewing. Russian nickel is sanctioned, spot inventory drops to just 80,000 tons, but the futures market is trading 1.1 million tons. That's 15 times more paper nickel than actual nickel exists. Wall Street sharks smelled blood. Elliott, AQR, and Jane Street, these hedge fund giants launched the most brutal short squeeze in commodities history. Nickel prices doubled from $24,000 to $50,000 per ton in days. But they weren't done. On March 8th, in a pre-market session that felt like financial warfare, they drove prices from $50,000 to over $100,000 per barrel. Tsingshan was facing $10 billion in losses, complete annihilation. Then something unprecedented happened. The London Metal Exchange, a 145-year-old institution, hit the emergency stop button at 8:15 a.m. and made a decision that shocked the financial world. They voided 9,000 transactions worth billions of dollars. The hedge funds were furious. They'd played by the rules and won, only to have the referees change the game. Lawsuits flew, but Tsingshan survived with only a $1 billion loss. Wall Street learned that sometimes being too big to fail means the exchange will literally rewrite history. April 20th, 2020, a date that will live in financial infamy. This is when crude oil futures didn't just crash to zero, they went negative $40 per barrel. Think about this insanity. Sellers were literally paying buyers $40 for every barrel just to take the oil away. How does this even happen? Here's the perfect disaster recipe. COVID kills oil demand, OPEC Plus can't agree on cuts, storage tanks are 80% full, and millions of retail investors from China, Korea, and India are buying paper oil products thinking they're getting the deal of the century. But there's a catch. These retail investors can't take physical delivery. Imagine someone showing up at your house with 1,000 barrels of crude oil. Where would you even put it? Plus, dumping oil is illegal everywhere. The delivery point for WTI crude is Cushing, Oklahoma, basically the only place you can legally take delivery, but storage was nearly full and rental costs were astronomical. So on April 20th, with just 2 days until delivery, 130,000 contracts still needed to be closed, and 2-3 of those belonged to retail investors who had to sell at any price. Wall Street went full predator mode. They shorted relentlessly, knowing retail had to sell before close. It became a death spiral. The more prices fell, the more panic selling occurred. At 2:30 p.m., when the market closed, oil hit negative 37.63s. Retail investors lost over $4 billion in a single day. One trader bought 20,000 barrels at 194 yuan and watched it close at negative 266. Losing over 9 million yuan. Now, before you think futures markets are just giant casinos, let me drop some truth. These epic battles are actually rare exceptions that make headlines precisely because they're so extreme. The real futures market is a massive risk management system. Airlines hedge fuel costs, farmers lock in crop prices, and pension funds manage interest rate exposure. It's about transferring risk from those who can't handle it to those who can. Yes, it's a zero-sum game where every winner needs a loser, but it creates price discovery, improves market efficiency, and helps the global economy function smoother. These legendary battles teach us that with great leverage comes great responsibility, that markets can be manipulated but usually self-correct, and that sometimes the house really does change the rules mid-game. If these financial war stories blew your mind, smash that like button, subscribe for more market madness, and let me know in the comments which battle shocked you the most. The 8-minute Chinese bond chaos, the nickel nightmare, or negative oil prices. Until next time, keep your leverage reasonable and your risk management tight. Peace out.